So today's webinar is approach and anticipating volatility, and we'll be covering liquidity gaps, compression, and a couple of things I don't like to see when price is approaching a level I'm interested in trading at. So the last webinar before the Q&A, we went over market structure and how to identify areas or prices which present good trading opportunities, based on this idea that price moves to the less liquid side of the market. And this week we're going to cover the kind of behaviors I like to see as price moves into a level, so the approach, specifically liquidity gaps and compression, both of which often precede volatility, which is really what we're interested in as traders. That's where the opportunity is. So I'm interested in how price moves into my level and how it moves out of my level. And as I explained in the first week, volatility is a function of liquidity. So price moves up and down as a result of the ratio of market to limit orders at any given price. And of course, the way in which market orders interact with that liquidity. So it pushes to the less liquid side of the market. In other words, if there's no liquidity, you might think of liquidity as a kind of friction. Price will likely move quite quickly. And this is what I want, for price to move with good momentum. So I'm watching the way in which price approaches my entry, because how price is behaving as it moves into the level is just as important as the level itself, and will often determine whether or not I think the trade is worth taking. What most people will do is they'll mark out a level, say it's some pocket of liquidity, right? And they'll, as price approaches, they'll wait for price to react at the level. So they'll look for a pin bar or a bearish engulfing candle, something like that, some sign that price is responding to the level, at which point the trade has already been and gone. Price has moved so far away from the level that your risk reward is shit, and price is quite likely already kind of bumping up against opposing order flow. And this is why people get chopped up. They wait for confirmation and then they chase price, and as a result their stop is too wide, and they're usually entering where they could have been taking first profit and even moving their stop down or taking risk off the trade. But instead they're now watching price move against them because they're getting in late, basically. And I'll come on to confirmation in the webinar and scale, because it is something I look for in certain situations, but I'm generally looking for something very specific, because my general opinion is that if you understand order flow and you recognize what's happening and what kind of price action is likely to increase the probability of the trade working out, you shouldn't be afraid of entering kind of at or close to the level. So what should you be looking out for? What is it you're looking for that will give you the confidence to execute at the level? And as I've said before, I don't personally like trading kind of mechanically based on, categorizing the different ways in which price moves, because I think the emphasis should be on recognizing probabilities and how those probabilities are changing in real time. But that being said, I'm going to do my best to explain the kinds of price action I like to see as price comes into or approaches a level. So the conditions under which I expect volatility, and then it's up to you to go find and internalize those behaviors so that you can recognize them in real time, so that you can recognize them as price is unfolding. So I'm generally watching for a few things when price is approaching an area I'm interested in trading at, and the first is a thin or illiquid move into the level. Excuse these drawings, but something like that. Candle's getting longer, right? The premise here, as I've explained, is that price is overextended as a result of the fact that price will often start kind of jumping in order to find counterparties when the market moves out of balance. And I showed you some examples of what this looks like on a tick chart a few weeks ago, but in case you need reminding, here it is again. It's just demonstrating how price behaves when it starts reaching for orders when it's overextended. So there are no candles here. These two white lines just represent the bid and the ask. But it's a nice kind of visual of what goes on inside the candle when price starts to overshoot. And notice that as price moves higher, it's having to reach kind of higher and higher with each influx of orders. And as it moves higher, the spread is getting wider and wider. Okay, see down here, the spread, this is Bitcoin, by the way. Down there, it would be $0.50. And see, as it moves higher and kind of climaxes up here, the bid and the ask, the spread becomes quite wide. So it's becoming more volatile. And what I've got here is just the same move I just showed you, but on a candlestick chart. And just notice that this is the area here. The higher price moves, the longer these candles get. Okay, small candles, get longer and longer, and that's not necessarily volume. That's the market reaching for liquidity in an environment in which liquidity is scarce, and it's this behavior which leaves a liquidity void or vacuum in its wake. So a gap in price, which I've explained, is quite likely to get filled if price starts trading back into that area. And it didn't fill immediately in this case, but what happens is that when buyers dry up and or finally get absorbed by some sell side liquidity, price will simply draw back into this void. And because volatility breeds volatility, it will often draw back just as fast as it came into the level. Okay, so as traders, that's what we want to see: a fast move into a level where we expect liquidity. So we've got a situation which repeats and which we can exploit, which is A, weakness on the bid side, and B, a situation where we can exploit it, that being the presence of liquidity. So volatility comes when there's an absence of liquidity, basically, and or when we get a big influx of orders. So what you always have to be asking yourself is where are these areas? Because you want to be taking trades at areas you know there's more than likely to be resting liquidity and trading or looking to run price through or into thin or weak legs in price. Okay, it's the same principle again and again.
So I showed you something similar a couple of weeks ago, but I'm just going to show you what this looks like on the cumulative volume delta again, so that you can see how easy it is for the market to completely retrace thin moves like the one I just showed you. So this is just some random price action I plucked from the FUSD chart, I think, and on the bottom again you've got the cumulative volume delta, and this here is the area I want to focus on first. So the market sells off quite dramatically, not unexpected given you've got this low here and likely some low off to the left, okay, which this was responding to, below which you have stop market orders, okay. So it sells off. And notice, the candle's getting longer here, okay. But because it's this is a highly illiquid move, it's weak, in other words, price retraces the entire move in the next candle, okay. It wicks up and then in the next candle it retraces the entire move. Even though in that next candle there was actually more market selling than buying, okay. Okay, it sells off here. That's the delta for that candle. And then in the next candle, a slight negative delta, and yet the market closes up. So that can only mean one thing, and that is an absence of liquidity on the sell side, a void in price. So just quite a nice kind of visual example of that. And you've got another quite nice example over here. Again, price shits itself, sells off quite rapidly below this low and below these minor lows here. Okay, so it's not unexpected. Again, there's way more market selling than there is buying in this candle. Strong negative delta, and yet you get this pin bar. Price closes more or less up where it opened. Again, as a result of the fact that there are so few sellers in here. And I know I've showed you this before, but I really want to drill this into your minds because this is the edge. This is why you want to be getting in at the end of thin or illiquid moves like this, because price moves to the less liquid side of the market, and as a result, you're more likely to get a good response.
Okay, I've just got a few examples here to make sure you know exactly what I'm looking for. This is actually a gold chart on the M15, and you can see that every time the market kind of extends like this, right, or like this here, right, candles getting longer. Every time the market extends or overextends, price comes back and fills in those moves. This is Ethereum USD again on the hourly, so that you can see how the same dynamic plays out across all markets. So, every time you get one of these kind of illiquid moves, they're not difficult to spot. Price comes back and fills in that weak or illiquid leg. It's got no trouble filling those moves. And just another example, this is cable, just so you can see the kind of price action I like to see as price comes into a level. Again, not hard to spot. Thin move, the candle's getting longer. That's what you're looking for. Okay. This here. Right. Because the way in which price responds when the market's moving like that is really quite consistent. And one more for good measure, this is the Bitcoin top. And for those of you who trade Bitcoin, you remember how bullish people were when price was up at the top here, and in here, in fact. But as I explained at the start of this program, it's often when the market looks most bullish that it's actually at its most bearish, because moves like this one here they're highly illiquid and therefore likely to get filled in quite quickly, whatever the time frame. So it's precisely this kind of price action that I'll look to fade if the market's running into a nice level. Is that clear to everyone? Great. Now, there's a difference between this kind of behavior and what I'd call impulsive price action, which looks more like, it actually looks more like this. Okay, let me just draw that out. See this candle here? That's what I'd call impulsive. And here I've got another example. I think this is Euro USD, and this on the right here, that's not what I wanted to see into a level. So big, wide-ranging candles from a distance, moves which you might consider kind of unusually large or outside of the normal course of a trading day on whatever pair you're trading. And that's why it's important to know your pair, and moves which break through areas of liquidity where you would normally expect some resistance, and when it's breaking those areas with apparent ease. Okay, in here, for example, see that untested liquidity smashes through it. So now we're looking to sell, I don't know, somewhere up in here. If I were to see price smashing through levels like that without even reacting to them, you want to stay out of it, or at least wait for more price action to develop. So, if we've got a liquidity gap, something like that, okay, we expect a high momentum, or quick or fast move through that area, okay, because there's no liquidity in there. There's no liquidity in there, and so why wouldn't price move through there with relative ease? Okay, in this case, this move is simply a function of liquidity. So if you've got a nice level, let's say you want to sell up here, you want to be taking these because more often than not, you'll at least get a reaction. Again, as a result of the fact that price moved into the level quickly, there's quite likely an absence of liquidity in that candle there. And that means you'll have time to manage your trade. And if it's no good, you can cut it. And if price consolidates up at the level, to cut it, you can get the fuck out because price isn't moving as you expected. So under the right circumstances, I want a fast move into the level. What I don't want to see is price smashing through resistance on approach. Okay, because that suggests either heavy or unusual buying for whatever reason, and or a lack of sell side liquidity where you might otherwise expect it. And under those conditions, it becomes less likely that levels we'd normally expect price to react at will hold. So what I'm looking for is something like, let's say we've got some structure like this. Okay, price comes down, stalls at this level, slips through here into this liquidity. That's fine. I'm expecting a fast move here because this move here was illiquid. It's not doing anything unexpected. So I'm wanting to see something like that rather than, let's say I want to buy there, rather than that. Okay, it's just smashed through this level. It's not doing as I would expect it to do if buyers are strong and sellers are weak. That makes sense. It's kind of the difference between this is Bitcoin here, between this, see this illiquid move in here. As a result, price moves through the area really quickly. In this case, I'm happy to buy down here. Okay, you see price retraces that move. The difference between that and something like that. Okay, price smashing through all areas of support. In this case, I'd be a lot more reluctant to be buying levels without more price action. Is that clear there? What I mean by impulsive moves and what the difference is between a thin or a liquid move and something like that. Great. And as I say, it's important to get to know whatever pair you're trading because obviously what constitutes an unusual move varies between instruments. And this is also why I wouldn't recommend leaving limits in before major news, because leading up to let's say an economic report with some key numbers, for example, banks or market makers they'll remove their orders, so they'll withdraw liquidity from the market, and price is therefore likely to slice through levels which might otherwise have stopped price in its tracks. And I've got quite a nice example here just to demonstrate. This is Euro USD again. I think this is a 30-minute chart, and I was watching this at the time when price was up here somewhere, wanting to buy this level. Okay, see, this is the FTR, high, low. It broke through here. This is the area from which price left with good momentum, and it hasn't been tested yet. So I would normally expect liquidity to be pooling there because it's fresh. And I can't remember what the news was. Some news came out here, but it was on the calendar, so I was well aware of it, and I was aware of it before this move happened. And just like I passed on this trade because I didn't want to stand in the way of news, large players or entities will also have been repositioning themselves or repositioning their liquidity. So imagine for a minute that under normal conditions, you'd have liquidity pooling, up at the highs somewhere, up at whatever level these highs are reacting to, and down here, okay, maybe a little bit of these lows. What happens is that before major news events, this liquidity gets pooled, and liquidity moves away from the market. So this liquidity here will get pooled, as will this, and it will start pooling at levels further away from the market. And it moves away from the market because traders they're expecting or anticipating and protecting themselves against volatility. And as a result, it's kind of a self-reinforcing dynamic. Price just blasts through this level, and it reacts down at this next area of liquidity. So, to be a good price action trader, you have to be aware of news events because they're going to have a big impact on the trading environment. And unless you're in a position to judge the significance of news, then I just recommend steering clear of news altogether, at least until price settles down. And by news, I don't just mean news. As I explained in the first webinar, price action itself can take on a significance of its own, such that an unusually large or high momentum move can kind of take on the character of news. Okay, it's somewhat of an event. So a move like this one here on Bitcoin is an event in itself, and will cause people to withdraw liquidity from the market, and that will fuel or exaggerate the move down. So just like you, they don't want to get run over. They being whoever's providing liquidity. So what happens is liquidity moves away from the market. Anyway, that's a bit of a side note. So be careful trading news because we expect volatility, and watch out for price action events, impulsive moves, in other words, because although these moves do tend to be illiquid, they'll often move a lot further than you might otherwise expect. Okay, while I'm talking about what I don't want to see ahead of level, so news or impulsive price action, I'm just going to go over basing. And as I've explained, one of the areas in which we can anticipate volatility is on the break of some significant structure, okay? Simply because these areas are likely to attract an influx of order flow. And Euro USD again on the M30. This here is what I mean by basing. Okay, just consolidation ahead of a level. So let's say I'm wanting to sell up in here, right? Price hasn't quite touched that level. This consolidation ahead of the level is not what I want to see. Because as I've explained, these highs, okay, the kind of upper part of this range of consolidation, those highs are points of reference or triggers for action, whether forced or unforced. So it's quite likely that when that consolidation breaks to the upside, the influx of order flow you often get on a breakout like that, largely comprised of stop losses, it's likely that will be significant enough to drive price straight through whatever liquidity there might be resting at your level. Okay, so you're watching out for areas where the break of which is likely going to lead to an influx of market orders. Okay, stop losses, breakout traders, the order flow from which is gonna consume that liquidity quite quickly. And again, same thing up at the top here. See how price consolidates ahead of this high here, and when it breaks, price just blasts through the level. So that's another thing to watch out for, and it's one of the times I'll look for confirmation rather than entering at the level itself. But confirmation and when I'll take it, that's something I'll leave until the webinar on scale, because it takes some explaining. It's also worth noting that areas of volume or consolidation like this one here, right, they represent potential sticking points for price. So if you're looking to fade a breakout like this, the first trouble area is just far too close. There's no value in the trade. What you want, again, is room for price to run. So it all comes back to whether or not price has space to move. You don't want to be shorting almost directly into an area where price could find support. You want to be trading areas where you expect price to move in your favor with relative ease, thin or weak legs in price, or areas in which liquidity is likely quite scarce. Any questions about that so far? Sorry about my incessant sniffling. It's quite a bad cold I've got. So things I don't want to see: consolidation or basing directly ahead of or too close to the level, major news events, and price action which I would consider impulsive. Okay. Things I do want to see: a thin or weak leg in price, okay, an illiquid move, price kind of drifting up into the level, candles getting longer, and compression. Okay, that's the second thing I like to see as price approaches the level. And compression is something you're probably all familiar with in one form or another, as it often comes in the form of a pattern. Okay, so a falling wedge like this one here, for example, is a form of compression. And this is, I think, XRP Bitcoin on MEX, or maybe Bitfinex. And what's happening here is each time price moves down, it's retracing and consuming the sell side liquidity, which is moving down with price. Okay, every time it moves down, it retraces and consumes the liquidity which it leaves behind. So imagine there's clusters of supply, each of these highs, right? Yeah. And each time price comes back up and tests those highs, it's consuming those orders. So the clusters of supply or liquidity at those levels are being at least partially eroded or consumed by those retests. Does that make sense? That's compression. And as a result, price has no trouble moving through that area when it eventually finds buyers. Okay, see how quickly it breaks out there. So you can almost think of this area here, this compressed area, as a void or vacuum in price, much like an illiquid move. And that's one of the things I like to see as price approaches my level, because the question I'm always asking is, what would prevent price from moving in my favor? Okay, so let's say you're looking to buy, I don't know, somewhere down here. Not the cleanest example, because you've got this gnarly wick there. But let's say you're looking to buy somewhere down there. The only thing which is going to prevent price from rising is sell limits. So we're looking for those to have already been consumed by the time we enter a trade. If there are sellers lurking just above our entry, that represents an obstacle. If something is going to prevent price from moving in our favor, then it's no good. There's no value in the trade. So it really pays to recognize what the consumption of liquidity looks like on a chart. And it's something like this, compression. And the same kind of mechanism is at work at most classical charting patterns.
Bull flags, triangles, okay. As I say, these kind of wedge type structures. Okay. As the range in which price is trading in gets tighter and tighter in these examples, price is consuming the liquidity. Let's take this example here in the middle. Price will have found resistance at some level here. Those sell limits, some of them start kind of moving down with price. But as price kind of trades through this area, all of that liquidity gets depleted. So as price trades in this range, it's kind of eating up the liquidity, which is keeping price contained. And as a result, price will usually break out quite violently. So here's an example of a kind of symmetrical triangle on cable, and you can see that the area above price here is totally compressed. Okay, that's all totally compressed, and even off to the left here. Okay, that high is a test of that. That's a test of that. That's a test of that. That's a test of that. Okay, so the next fresh liquidity is all the way up in here. And you see that's where price finds resistance. Okay, so this whole area okay, that's all compression. Okay, there's very little liquidity in there, and you can see as a result, price moves through there quite violently. And of course, you've also got stops building above those highs as well. You'll have stops up here, which will fuel the move up. And as I explained in the first week, the speed at which price usually moves here will also have momentum traders jumping in and market makers pulling their liquidity. So same dynamics again and again. We can expect volatility when there is little or no liquidity. Okay, in this case, you haven't got a gap or a void, but you have got the consumption of liquidity in the form of compression, and or when we get a big influx of orders. Okay, and this is one of those areas: compression, consumption of liquidity, the build-up of stops. Okay, so you know you're likely to get an influx of orders there, and so it's just about finding these areas. That being said, I don't particularly like trading structures like this one here, because as you can see, price is kind of compressed on both sides here, and so it it could quite easily have just broken either way here. There's also no clear level, so ideally what I want to see is something more like this. Okay, there's your liquidity, and prices rising or falling if you're looking to buy, and as it moves up, prices coming back and consuming all of the residual liquidity. Okay, so see price runs out of this level, leaves this fresh liquidity, comes back and tests it. Okay, the same here, runs out this level, comes back and tests it until price finally reaches some fresh sell side liquidity, and at this point, that's the last available buy side liquidity. It's exhausted here. Okay, there's likely very little sell side liquidity in this area, and you've got a fresh level here. Okay, and as a result, price kind of slices through that area. So it's kind of almost kind of clearing the way, as it were, for a nice move down. And there are a couple of ways you can trade this kind of price action, but first I just want to make it clear that not all wedges are compression, not all triangles or bull or bear flags are compression. It's really not about the pattern, it's about the order flow dynamics which is shaping the pattern. So for example,
what I often see is
people drawing out these kind of wedge type structures or triangles, and they'll mark them out like that or like that. But very often you'll see that there's still untested liquidity somewhere up in these structures. And so you have to remember it's not about the pattern, it's about assessing whether or not the liquidity at these levels has actually been consumed. And so when you're marking out compression, watch out for areas of liquidity which haven't actually been tested. These levels explain why you'll often get, fake outs like that, so-called fake outs. Okay, people will draw kind of structures like this out. They'll short on the break, but they are, I guess, unaware of the fact that there is still untested liquidity somewhere in that structure. So watch out for that, because that kind of explains why price will often appear to break out these structures and then just suddenly reverse. And this is when I just plucked from SBTC, I think on MEX, but you see this all the time. Again, you've got some people will have had some kind of, I don't know how you draw it out, some kind of triangle structure marked out, and lo and behold, price breaks out. Let me draw this a bit clearer. Okay, that's better. Lo and behold, price breaks out because, well, this area is totally compressed. Okay, see, that's a test of that. That's a test of that. You can see all these wicks in here. That's the consumption of liquidity. Right, so price is totally compressed up until here, and above that you've got a liquidity void. So it's no surprise that price has no trouble moving through the area, but there is still fresh liquidity up in here, and the same in here, in fact. Okay. Notice how those areas were never really tested, and as a result, price quickly reverses and stops everyone out. So this is just to demonstrate, it's not about the diagonals, it's not about the pattern. It's about identifying areas in which you expect there to be liquidity pooling, and making sure those have been tested, and you think they've been at least largely consumed or eroded before you start longing this. Similar kind of thing on Bitcoin last year. I remember everyone had this structure marked out. Okay, but this isn't compression, and as a pattern, it's meaningless because there is quite clearly fresh untested liquidity up in there. Okay, so that's not compression. There are multiple areas in here at which I would expect there to be liquidity. So when marking out areas of compression, you you need to make sure you're not ignoring untested levels. What you want is for each of these pockets to have already been consumed when you get in trade. Is that clear enough? Similar kind of structure here again, but multiple points at which there is liquidity, and as a result, price finds resistance there. Let's get on with it. I've just got a couple of examples of compression here, so it's totally clear what I'm looking for. This is a really nice example on gold. This is your flag structure. Okay, this is the flag limit. Flag limit, which is kind of supporting the structure here. So you might think of this whole consolidation as kind of feeding off the residual liquidity in here. Okay, so I'll just track it here. Let's say you had some buyers here. Some of those buyers move up to this level. Okay, that gets tested there. That gets tested there. Tested multiple times. That gets tested there. As price runs up, you can see that it dips back into these levels. Okay, that gets tested there. That gets tested there. That gets tested there. Okay, so you can see that over the course of this range, the liquidity down at these lows gets totally consumed. And so at this point, you've got fresh liquidity up in here. See that? Price never came back and tested that level. But where is the next available liquidity below price? Well, it's all the way down in here. That's why you get such a sharp sell-off when price breaks down through this low. So again, what we're looking for, the presence of liquidity combined with the absence of liquidity. In this case, it's not a gap, but it comes in the form of compression or the consumption of buy-side liquidity here. Because that's when you get volatility, that's when you get that high momentum move. This is Euro USD again, this time on the H4, I think. Another nice example of compression here. Okay, I don't need to mark out the retest there. You can probably all see that. There are two ways you can trade this. One is to enter at the level. Okay, so where is their buy side liquidity? Down in here. Okay, never actually comes back and tests that level, but one method of entry is to note the compression and then enter at the level. Okay, at a level where you expect there to be liquidity. The idea being that sellers in here are relatively weak now, and you've got fresh buyers coming down here. You can also wait for the price to break into the compression before getting in on a pullback. Okay, so you note the series of lower highs and lower lows here, and then when price breaks that, okay, the other way you can get in here is just to get in on a pullback there. So wait for that break in market structure, and then you can jump in. So I think this is gold again. It's on the M15, and this example is quite kind of instructive. I think I won't bother marking out the compression. It should be quite clear here. But the first point I want to make is that it is often a good idea to wait for that break in market structure I just mentioned. Excuse me. The prices start moving into this compressed area, to start breaking lows, in other words, before you get in, because compression can often go on for longer than you might anticipate. So here, for example, price compresses up into the level, but it just results in a pop here, a pop through that level. That being said, when price comes down and tests this flag limit, okay, that's your flag structure, that's the flag limit. Once, twice, and then moves up like this. So on the lower time frames, okay, all of this is compressed, okay. Then this pocket of liquidity up in here starts looking very attractive for a short, because you've got compression here. That flag limit has been totally consumed. In the lower time frames, that's totally compressed, okay. So you have room for price to run, and you've got a fresh pocket of liquidity up in here. And indeed, price breaks down from there quite rapidly. But also just note, even though it sells off here, just note where it pauses as it moves down, because there are a couple of areas in here which weren't actually tested. So here, for example, see price never came back and tested that. There's still some residual liquidity there. See price finds support for a brief time. The top side of this area was tested, but likely there's still some liquidity down in here. Okay, and down at the low here, that was never tested. So as a result of these areas, price does stall on the way down. So it's always important just to be aware of those areas, because they are what are going to stand in the way of you and your target. Okay. And finally, this is Euro JPY on M15. This was a really nice trade I took a few months back, based on a combination of factors. The first being this kind of false break of the lows there, fake out below those lows, which I'll cover in the webinar on false breaks in a few weeks. Also note the illiquid move down, which gets quickly reversed. Anyway, I didn't take the trade down here. What I want you to pay attention to is this area up in here, which you can see is almost entirely compressed and therefore really weak. So there's a little nugget of liquidity down at the bottom here. Okay, the area from which price broke out of this with momentum. Okay, that never really got tested, and so that's why price stalls there. And that's what I'm wanting to see consumed before I get in here. As far as I can remember, I waited for the price to consume that level and break through it, and then I got in on a pullback to this fresh liquidity, knowing that price is very likely going to run quite quickly through this whole area, through this gap to the next area of liquidity up in here. Okay. So quite a simple trade based entirely on just assessing where there is liquidity and where there is not liquidity. Okay. There is liquidity in there. There is not liquidity in there or in there. So a nice example of price having room to run. Anyway, I think that's all for today. I hope this has given you a good idea of the kind of price action I'm looking for on approach, as well as when to expect volatility. What I'm hoping is that as you come to kind of understand and internalize the dynamics I've been talking about over the past few weeks, you'll get better and better at identifying different trading environments, different states of liquidity, and that you'll start picking up on or noticing how specific environments often lead to quite predictable outcomes. So, as I said last week, I think it's so important that you develop a kind of roster or catalog of experiences, a relationship with price based on your own observations and That way, when it comes to actually pulling the trigger, you're unlikely to be overcome with fear or doubt, because you'll have seen, X or Y scenario play out hundreds or thousands of times. So you'll have a good idea of what the likely outcome is of any given scenario, and hopefully you'll develop trust in that probability. Okay, so through engaging with price, my hope is that you'll come to know when to expect volatility, like in this example here, and when exactly that shift should occur, so that once you've identified a level, you're able, and you'll also have the confidence to take trades at the level, and without having to think twice about pulling the trigger. And of course, the market's, it's constantly shifting and evolving. It's dynamic. And sometimes price action just won't be clear to you. That's just something you need to accept. So you should be waiting until you see exactly what you want to see in the area you want to see it. And then when the conditions are right, when you see exactly what you're looking for at the area or the level you want to see it, you'll be ready to execute without fear or hesitation, because you know what you're looking for. Basically, you know what kind of price action you want to see to increase the probabilities of your trade working out.